The real truth about your taxes. This is the stuff no one tells you, but I am. How to get the biggest refund and avoid crazy penalties. This will save you thousands of dollars. Everything you need to know in this one video. Let's start with the biggest myth of all, one that'll cost you big. When I file an extension, I can pay my taxes late, right? Wrong. An extension gives you extra time to file, but it doesn't extend your time to pay, and penalties can really add up fast. The IRS doesn't play around. Let me walk you through it. Go to the IRS website on a desktop or a laptop, not your phone. It's easier from a computer. It's irs.gov. Then click File, scroll down to Information for Individuals, click Get an Extension, and under Request Extension by Mail, there's a link called Form 4868 Application for Automatic Extension of Time. Go into Form 4868, fill out the form, mail it to the IRS. You have your extension. It's that simple. The key, though, and this is very important, and you need to hear it, the key is to file it by the original tax deadline, April 15th. This extension pushes your filing deadline to October 15th, giving you a lot of time to get your documents in order. But here's the catch. There's always a catch. An extension to file does not mean an extension to pay. This is where so many people I know screw up and end up owing so much more money. Even with an extension, you are still required to pay your estimated taxes, pay all the taxes you owe, by the regular date of April 15th, just like everyone else. When you file for an extension, it's an extension to submit your actual return, the actual paperwork. So here's the deal. Even if you file for an extension, you still must pay at least 90% of what you owe to the IRS by April 15th or face a failure to pay penalty. It sounds bad, and it is. And don't forget about interest. Interest builds up on the taxes you owe. So bottom line, filing a tax extension is cool if you need more time to prepare your papers. Just make sure you pay at least 90% of what you owe by the regular tax day, the one we all hate, April 15th. Here's another question that causes confusion. What about deductions? What can I write off? Trust me, make the wrong move and you could be leaving money on the table. We don't want that for you. I'm not going to let it happen. Let's break it down. You can take the standard deduction, also known as the no fuss option, when you're filing your taxes. The standard deduction isn't something you list as an itemized expense, right? Instead, it's a fixed dollar amount that's automatically applied when you choose the standard deduction on your tax form. For 2024, those amounts are: single or married filing separately is $14,600. Married filing jointly is $29,200, and head of household is $21,900. So no need to list individual expenses. Claiming the standard deduction is simple, doesn't require detailed record keeping. Nice and easy, no fuss. But if you have lots of expenses, you may want to choose itemized deductions or the customized route. Itemizing allows you to deduct specific eligible expenses from your income, potentially reducing your tax bill even more. Common itemized deductions include mortgage interest, interest paid on a home loan, state and local taxes, including property and income sales taxes, charitable contributions, donations to qualified organizations, and medical and dental expenses. Out-of-pocket costs exceeding a certain percentage of your income. Bottom line, do the math. Don't assume one size fits all. Calculate both options, see which one benefits you the most. You get a little more back this way, do it that way. A little effort now can lead to big time savings later. Now, if you work freelance or have your own company, you may really be in business. There are new rules for tax deductions, and I got them. Rossen Reports viewer Mark wrote to me, I drive for Uber, so I'm self-employed. What tax deductions can I take? First up, your vehicle expenses. The IRS offers two ways to deduct those costs. Method one, the standard mileage rate. For the 2024 tax year, those are the taxes we're filing now. It's 67 cents per mile. Method two, actual expenses. Tally up all of your car-related expenses: fuel, oil changes, tires, any repairs, insurance, even lease payments, any expense related to the car. Compare both methods to see which gives you the bigger deduction, and use that one, obviously. But don't forget about tolls and parking fees. Those count too. Every dollar you spend while driving for Uber or Lyft or any rideshare company or whoever you drive for is fully deductible. Keep those receipts or write them down. Your phone, by the way, is your mobile office. If you use it 60% of the time for Uber, you can deduct 60% of your phone bill, and even phone accessories, deductible. And those service fees and commissions Uber takes, Deductible, they're business expenses. Check your Uber dashboard or tax summary for the exact amounts. And pro tip here, use a mileage tracking app like MileIQ or Everlance to record all the miles you drive. Those are both free, by the way, and we love free. Remember, Uber, Lyft, whatever company you freelance for, should send you tax documents. Okay, a lot of you on social are asking, am I taxed when I work overtime? Yes, I'm sorry. Overtime pay is taxed just like your regular wages, federal income tax, state income tax, Social Security, and Medicare. Another question going around. During the elections, I heard a lot of politicians say my tips won't be taxed. Is that true? No, it's not true. The No Tips on Tax Act has been proposed to eliminate federal income tax on tips, but it has not been passed into law. So this year, your tips are still considered taxable income and must be reported to the IRS. Let me say it again. Tips are taxed this year as regular income. Next question I get a ton. I'm a college student. Do I file independent or as a dependent? Now here's the deal. You can file independently on your own, but you need to take a few things into consideration, right? Eligibility. Typically, if you're under 24, a full-time student for at least 5 months of the year, and provide more than half of your own support, you can file independently. And there's an income threshold. For the 2024 tax year, that's the one we're doing right now, single students under 65 must file a tax return if their gross income is at least $14,600. Let me break this down even more with pros and cons. Pros of filing independent: control. You can manage your own tax filings, potentially qualify for credits like the American Opportunity Tax Credit, and that's serious cash in your pocket. We're talking up to $2,500 per student. Another pro: financial aid. Independent status may increase your eligibility for financial aid programs. Let's look at the cons. Your parents may be angry at you. They won't be able to claim you as a dependent anymore, which will lower their tax benefits. Okay, so maybe you love your parents, you want them to declare you as a dependent for a little while longer. Here are the rules. Parents can claim you if you're under 24, a full-time student with at least 5 months of the year in school, live with them for more than half the year, and don't provide more than half of your own support. Let's look at the pros of that. You basically become an expense on your parents' taxes. They can qualify for bigger tax breaks like the child tax credit or the head of household filing status, which can really lower their tax bill. Go parents. The cons? Limited financial aid. Your status as a dependent could affect your eligibility for certain financial aid packages. Here's another big question, especially now in 2025. I work from home. What can I write off? Is there a magic number of days you need to clock in from your couch to get those sweet deductions? Now here's the reality check. It's not about the days. The IRS doesn't care if you work from home 1 day a week or all 7. What they do care about are 2 biggies: regular and exclusive use of your home for business. Translation: you need a dedicated space that you use consistently and only use for work. No mixing business with pleasure here. So if you have a home office you only use for work, here's what you can write off. You have 2 methods. First, simplified method. Deduct $5 per square foot up to 300 square feet with a max deduction of $1,500. For example, if your home office is 200 square feet, your deduction would be 200 times $5. That's $1,000. Second is the regular method, meaning you can calculate your actual expenses based on the percentage of your home that's used for business. So let's break that down. Let's say your home is 2,000 square feet. Your office is 200 square feet. That's 10% of your total square footage. I'm bad at math, but even I knew that. That 10% is the magic number. Your rent, $2,000 a month. So 10% of your rent is $200 a month or $2,400 a year. That's tax deductible. Then your utilities like electric and gas come to $300 a month. What's 10% of that? $30 a month. You can deduct that, or $360 a year, deductible. And we're not done. Let's say your property taxes are $6,000 a year. 10% of that is $600 a year, deductible. Total home office deduction, $3,360 a year. But here's the bummer. You can only deduct a home office if you work for yourself. Sorry to burst your bubble, but if you've got a W-2 job working remotely for an employer or a company, you can't write anything off at home, even if you're fully remote. No deductions for you. No deductions for you. Have any questions I didn't answer? No problem. Drop a comment. I'll reply with an answer to help you with your taxes. Plus, like this video, subscribe to our channel so you're notified first when we post new content.